Hello and welcome to the IB Business and Management course online. I'm Mr. Burden. Today I'll be running you through our fourth and final installment in our 3.5 financial accounts section of our accounts and finance part of our IB Business Management course. Stock valuation is what today's all about. I do hope you're watching this video embedded in ibbusinessandmanagement.com. Your one-stop place for everything you need to know about the IB Business and Management course. Everything you need to know to get you the 7 that is the top mark. Okay, stock valuation is all about looking at the value of a stock a business has on hand in any set period of time. So we're valuing the firm's inventory for the trading account. Stock is purchased in and stock is sold. Products are sold. Often a firm's stocks will consist of the same goods bought at different times and at different purchase prices. That bears repeating. Often a firm's stocks will consist of the same goods bought at different times and at different purchase prices. And all that means is that perhaps I'm using the same supplier, buying the same goods off the same supplier at different times of the year. Perhaps prices are increasing in the economy, so the same goods bought at different times may well have different purchase prices. They could well be more expensive later on in the year when they're bought at a later stage. Again, it's a high-level topic, and stock valuation is important. It's showing up in our trading account and a profit and loss account. It's very important for the cost of goods sold. Cost of goods sold calculated as opening stock plus purchases less our closing stock. This is the cost of goods sold section in the trading account. And remember, this determines the gross profit. Sales revenue less the cost of goods sold determine our gross profit, and that gross profit will feed on through into our net profit, how much tax we pay, etc, etc, etc. So this cost of goods sold thing is important, and stock valuation is important because it can affect the cost of goods sold. So please keep that one filed away at the back of your brain, because this is what stock valuation is all about. Let's have a look at an example here. We've got a tyre company, a tyre retailer perhaps. Now they had 6 tyres left over from 2010. They bought 50 in January of 2011 at $25 each. Another 10 in February at $30. They bought 100 in March at $20, and they sold 130 tyres between January and March. We need to be able to go away and work out the value of the closing stock. Stock valuation is what it's all about. And if there's one thing in the world, and not in the world, but in the IB Business Management course that students struggle with, it's stock valuation. Our 2 techniques, FIFO and LIFO. Gosh, doesn't it confuse so many students? Now, it's not crazy difficult, but it is crazy logical, step by step by step. We are going to introduce you to 2 different types of stock valuation, and each of these will have different effects on the cost of goods sold, and each of these will have in turn an effect on the gross profit. First in, first out, this is where stock rotation is important for perishable stocks perhaps. So the first goods that you've bought in are the ones you want to get rid of first. You don't want to be selling off your newest milk You want to be getting rid of your old stock first, the perishable ones, before they start to perish. So the first of our techniques we want to look at is first in, first out, FIFO. Now gross profit, remember, it's equal to sales revenue minus the cost of goods sold. Cost of goods sold, opening stock plus purchases less closing stock. So each of the different stock valuation techniques we're going to look at the moment is going to give us a different value of the closing stock. One of these is going to produce a higher closing stock, and one of these is going to produce a lower closing stock, with implications for tax paid. If we are able to decrease the value of our closing stock, then the following chain of events automatically occur. Decrease the value of our closing stock, we get an increase in our cost of goods sold. Increase in the cost of goods sold, we get a decrease in our gross profit, and if we get a decrease in our gross profit, we get a decrease in the amount of company tax paid. So it is a tax avoidance technique for large companies. I say tax avoidance, remember that tax avoidance is legal, tax evasion is not. Right. We've got a profit and loss account here. This is where our stock valuation is going to come into play. Opening stock, purchases less the closing stock. It's that closing stock that's all important. If we can decrease the value of our closing stock, then that flows on. Cost of goods sold increases, gross profit decreases, net profit will decrease, and that will reduce the amount of company tax that we do pay. How can we do that? We can do that by using the last in first out technique. So stock that is bought earlier is usually purchased for less. Prices tend to rise in an economy. If we're buying tyres off our supplier in January, by the time December rolls around, those same tyres are likely to be more expensive. If we use a last in first out technique, that means if we sell off those tyres that have just come in the door, we sell them first, it tends to leave us with our older stock. First in first out will leave us with our newer stock. Last in first out typically leaves us with our older stock. So that's really, really, really key to get into your minds right now. The first in first out technique, the FIFO technique, is going to leave us with our newest stock, and the valuation will be based on our newest stock. The last in first out is going to leave us with our older stock, and that older stock is typically going to be valued lower. So here we are, the dreaded FIFO LIFO. We have grabbed the same figures here that we ran through in our previous slide. So on the 1st of March, 30 tyres have been bought at $25. The 5th of March, we sold 20 tyres and we did that at $25. 8th of March, 20 tyres bought in at $30. And 15 tyres at what on the 10th of March? Let's have a look. If we buy in 30 tyres, we've obviously still got 30 tyres in there. We haven't sold anything yet. So 30 tyres at $25, all we have to do for our stock valuation. And gosh, I've been repeating this over and over and over again in this financial accounts section, but the structure of this whole thing is incredibly important. Date, stock bought, stock issued, remaining stock, stock valuation. It's the stock valuation column that's key, and to be able to correctly calculate this, we need to have our other columns set up appropriately. So 30 tyres at $25 each will leave us with our stock in store is valued at $750. We issue 20 tyres. Don't worry about the price, that's irrelevant at the moment. 20 tyres, so that would leave us 10 tyres left in stock. Those 10 tyres will still be valued at $25. So 10 tyres at $25, $250, the valuation there. 8th of March, we buy in more stock, and we can see this time that our tyres, the purchase price is more. They've gone from $25 to $30. So we've got 10 tyres at $25. Those are our older tyres, and 20 tyres at $30 now. Sum them to give us a total stock valuation. So 10 tyres at $25 and 20 tyres at $30. Our stock valuation as of the 8th of March is $850 worth of tyres. The last in first out technique would leave us with 15 tyres at $30. So 10 have been issued with under FIFO. 10 would be issued at $25 and 5 would be issued at $30. So 15 of those tyres, we're going to use up our old stock first. Now remember, our old stock was purchased in at $25, so we get rid of all our older stock. 10 tyres at $25, and we need to take another 5 of those newer tyres that came in, so they were valued at $30 each. Right? 10 tyres at $25, $250, plus 5 tyres at $30 at $150. That sums to $400. So our stock valuation at the 10th of March of $400, and if that was appearing in our profit and loss account, it would be affecting the cost of goods sold. We've just worked through the top table, nothing there, nothing different there, and let's have a look at this bottom table using the different stock valuation method, and this time we're going to use the LIFO method. So the whole aim of the LIFO method is to leave us with our older stock at the end, our older stock. So we can see on the 1st of March, nothing's different there. 5th of March, nothing different. We just 8th of March, nothing different. But on the 10th of March, when we're issuing stock, we do so at a different valuation. LIFO, we're getting rid of our new stock to be left with the old stock. FIFO, we're getting rid of our old stock and leaving us with our new stock. So this time we're going to take 10 tyres at $25 and 5 tyres at $30. Here we are, 15 tyres at $30, $450. $450 is our closing stock valuation as of the 10th of March. So you can see that using the two different technique results in two different stock valuations. Two different stock valuations, and if we just have a look at these side by side again, we can see that the only thing different there is on the 10th of March. Our closing stock is lower, and therefore our cost of goods is higher, and following on from there, our gross profit is going to be lower. So using the LIFO technique, we can see on the right hand side here with the yellow highlighting around it, the LIFO technique leads to a lower closing stock, higher cost of goods, and lower gross profit. So the LIFO technique can minimize our tax obligations. And if we put in that 450 using the FIFO stock valuation and the 400 using the LIFO stock valuation, now the trading account and FIFO and LIFO go hand in hand. It's very likely if you get a FIFO or LIFO question that you're going to get a trading account implication type calculation as well. So we can see there the only difference between the trading account using the two different methods is the closing stock. FIFO has a higher closing stock value, feeding through into a higher gross profit. LIFO, the lower closing stock value leading through to a lower gross profit, and the tax implications follow, which is what it's all about, really. LIFO and FIFO, let's run through another example. We'll try and make it a little bit more clearer. The more examples of this we can practice, the more we've got the structure into our business heads here. Right, we've been given some financial information and we are going to have to go away and do some calculations on it. So January, we can see that we're January, February and March, we're purchasing the same amount of stock. The cost of our stock in per unit is increasing across that time. We're selling the same amount in each month, and our value of stock purchase it's increasing as the cost per unit of our stock increases. We've been given some additional information. Our opening stock is at the 1st of January. So this is before we buy in our January stock. We already have 1,000 units and we'd previously bought these in at $9 each. And another note down the bottom here, the market price, we're selling our units at $20 each. So here is a typical exam question. Using LIFO and FIFO stock valuation methods, construct, yes, you may well have to construct a profit and loss account to show the effects on the trading profit. A 6-mark question, which is significant. Sales, 60,000. Sales 60,000. We can see that we've issued 1,000 January, February and March, 1,000 each of those months. That's 3,000 times $20 per unit, 60,000 there. Across to cost of goods sold. Oh, sorry, FIFO. The figure does not change. Opening stock, we've given that in the first note. Opening stock is at the 1st of January, 1,000 units at 9,000 each. That's $9,000. That's the same for FIFO. Purchases will be the same across both types of stock valuation methods. What did we purchase? We purchased in $33,000 worth of whatever these are. Closing stock. Now this is going to be a little bit different depending on whether we use the LIFO or the FIFO technique. Now think to yourself, LIFO, are we going to be left with our old stock or are we going to be left with our new stock? FIFO, will we have our older stock on hand at the end or our newer stock? Our older stock is valued less than our newer stock. We can see that we have got 4,000 including our opening stock of $1,000, 1,000 units, sorry. We got 1,000 before we started in January. We got another 1,000 in January, another 1,000 in February, another 1,000 in March. So 4,000 units have come to our hands in these 3 months. We want to know what the valuation of the closing stock is. In January, our lowest priced value of stock purchase is $9. In March, the cost per unit of our stock is $12. LIFO leaves us with our oldest stock. We got 1,000 units at $9 as our closing stock, and FIFO 1,000 units at the newer $12 cost per unit, which leaves us with 12,000 in closing stock. Cost of goods sold, opening stock plus purchases minus our closing stock under LIFO comes to 33,000. FIFO, we do our sums, we've got 30,000. Gross profit, $60,000 in sales minus our cost of goods sold leaves us with 27, and under FIFO, higher $30,000. Who's going to pay the less tax? Which stock valuation method is going to result in the less tax being paid? Obviously, LIFO, our tax obligations are going to be lower because our gross profit is lower. So what's the key thing to take away from this example? LIFO, you are going to be left with your older, cheaper stock at the end, so that valuation is going to be lower. FIFO, you're getting rid of your older stock, you're leaving yourself with the newer stock. Your stock valuation at the end is going to be higher. Okay, we're going to run through another example, and this one, the level of difficulty is increasing. There are more things to take account of. So, looks like we're going to be given some information, and we are going to either have to use a LIFO or FIFO method. Now, we're going to do this in turn, but just remember, LIFO, last in, first out. At the end, when our stock is valued, we're going to be valuing our older stock. Remember, older stock is typically valued less. Under the first in, first out, FIFO, at the end of the day, when we come to value our closing stocks, we are going to be left with our newer stocks in hand. Our newer stocks are typically going to be worth more. So let's start with LIFO. The structure is important. We've got the date, stock being purchased, stock being issued, and a closing stock. What information are we going to be given? Here's the first. 10 TVs in stock on the 1st of February, and these were bought in at $190 each. Sorry, just getting ahead of ourselves to start with. So, 1st of February, opening stock, 10 in at $190. The 2nd of February, 10 TVs have been purchased at $200 each. So stock purchased, which leaves us with closing stock of 10 at $190 and 10 at $200. On the 5th of February, 10 TVs have been sold. Now remember, LIFO, we want to leave ourselves with our older stock. So we've had a choice there. We had 10 TVs in at $190 and we had 10 TVs in at $200. We sold or issued 10 TVs. Now we could have, whether it's LIFO or FIFO would determine which valuation we're going to pick and choose from. We're looking at LIFO, we want to leave ourselves with our older stock, we want to issue our newer stock first. So on the 5th of February 2013, when we issued 10 TVs, we issued them the newer TVs. So 10 at $200, which would leave us with our older TVs only in stock at the moment. th of February, 50 TVs have been purchased. We can see that this costs the firm substantially more. TVs have been purchased in at $220 each now. We'll add these 50 TVs on to our stocks of $190, 10 at $190. So 50 at $220 and 10 at $190. Now we know, because we're in LIFO, we are aiming to keep our stocks as old as they can be, that any stock we now issue are going to come from the more expensive and the more newer stock of TVs that we have on hand. So here we are, we've got sales of 40 TVs on the 9th of February. We need to take those from our newer stocks. And if we take 40 of our newer stocks, that must leave us with only 10 left at $220, and we still have 10 there at $190. I hope you can see how it's starting to work now. LIFO, we want to leave ourselves with our older stock, so we're using up our newer stock as much as we can, as much as we possibly can. 16th of February, 100 TVs come in. We've bought them at $250 each. So now we have got 10 at $190, 10 at $220, and 100 TVs at $250. On the 21st of February, 80 TVs have been sold. Are we selling our old ones, or are we selling our new ones first? Right? LIFO, think to yourself, we're leaving ourselves with our older stock. We're going to eat into our newer stock as much as possible. So 80 TVs sold. They all must come from the higher valuation of our newest stock in. So those are the TVs that we bought in at $250. 21st of February, we sold our TVs and we sold our newest TVs. So 80 at $250, which leaves us 10 at $190, 10 at $220, and it must leave us with 20 of our $250 TVs. A complete run through of a LIFO stock valuation construction type question, as difficult as you'll see, as difficult as will be thrown at you. It's logic and structure, and all the time thinking to yourself, are we being left with our older stock, or are we being left with our newer stock? LIFO older. Stock purchase, important for constructing our profit and loss account, our trading account, sorry. And the all-important value of closing stock. So if we add those up, we've got a value of closing stock, and we'll be able to plug that in to the appropriate place in our trading account. So keep that in the back of your mind, and we'll just quickly run through our FIFO example. So if LIFO was all about keeping our older stock in hand as much as possible, because the value is less. FIFO is getting rid of our old stock and being left with our newer stock. FIFO, we want to be getting rid of our old stock, leaving ourselves with our newer stock as much as possible. The information will be exactly the same. The dates purchased, the stock issued. The only thing that's going to be different is the closing stock. Which stock are we going to issue this time? So, 10 TVs in stock 1st of February. We plugged that figure in. 1st of February, 10 at 190. We purchase in on the 2nd of February 10 TVs at $200 each. There we are. We add those 10 TVs to our existing stock of 10 that we bought in at 190. We haven't sold anything yet. We're going to do that next. Here we are. 5th of February, we sell 10 TVs. Which TVs are we going to use? FIFO leaves us with our newest stock, so we get rid of our older stock at first. Our older stock is the one that's valued at 190. This is the stock that we issue, leaving us with our newer stock, our more expensive stock in hand. We buy some more TVs in on the 7th of February, 50 at 220. So we'll add these TVs to our existing stocks. Ninth of February, we sell 40 TVs. Now we want to leave ourselves with our newest stock. So the first thing we're going to do, is use up our 10 at $200 TVs. Take the remaining 30 TVs that we need from our pile of 50 at 220. So once we issued our older stock, we've got no more $200 TVs remaining in stock. All we've got now is 20s at 220. You can see that we're leaving ourselves with our newer stock. We're getting rid of our older stock. 16th of February, 100 TVs come in. We buy them in at $250 each. We add these TVs to our existing stocks, and our existing stocks are 20 TVs which we purchased at $200. 21st of February, 80 TVs are sold. And remember, FIFO, we want to leave ourselves with our newest stock. So if we have a look there at the closing stock at the moment, closing stock as at 16th of February, we know that we want to get rid of our $200 TVs. These were the ones that came in first. So if we're selling 80, we're doing so with 20 from our $200 stocks and another 60 from our $250 stock, which will leave us with 40 TVs at 250. Now remember, I said at the start, that FIFO is going to leave us with our newest stock. Here we are. We know that the bulk of our stock is going to come from our most recent purchases, and in this case the whole lot does. So our closing stock valuation, we've got 40 at $250. You don't have to be a rocket scientist to work out the valuation of our stock. Purchases necessary for a trading account, closing stock necessary for our trading account as well. So we've been through the LIFO example. We've been through the FIFO example. The question asked to show what was the impact on our profit and loss account, trading account, sorry. We've got our LIFO up the top, we've got our FIFO down the bottom. Purchases are the same, it's just the value of closing stock which is going to be different. And we were given that information. Remember that our TVs were being sold at $400 each. So how many stocks were issued? Multiply these by 400, $52,000 in sales. Cost of goods sold, opening stock is the same across both LIFO and FIFO. Purchases, nothing different there. We bought in 10 at $200, 50 at $220, 100 at $250. If we sum those, we come to $38,000. And here comes the difference. LIFO gives us a different closing stock figure. FIFO gives us a different figure as well. LIFO is going to be lower. Our closing stock, value of closing stock, we've got 10 TVs at $190, 10 at $220, and 20 at $250. If we sum these, we've got closing stock of $9,100. Across to the FIFO side, we've got 40 TVs in stock. These are the newer ones at $250. So 40 at $250. That'll leave us with $10,000 in closing stock. Do our sums for our cost of goods sold. Opening stock plus purchases minus closing stock will leave us with $30,800 under LIFO and significantly less under FIFO at 29.9, the cost of goods sold. Gross profit, sales minus cost of goods sold, $21,200 under LIFO, 22.1 under FIFO. This will feed through to net profit, and it will feed through the amount of tax that this business is paying. Under LIFO, gross profit's lower. The government gets their hands on less of our hard-earned income, which is what it's all about. Tax avoidance, not tax evasion, tax avoidance. And in fact, a lot of countries will not let companies use the LIFO stock valuation method. The first in, first out will be the required valuation method to minimize that tax avoidance. So here we are, under LIFO, less gross profit. And if we have less gross profit, repeat it, less company tax is going to be paid. And the whole point behind this very stressful, very difficult, very logical stock valuation techniques that we try so hard to get you students to learn is that it has significant tax implications.